Hello everybody, my name is Maurice Button. I'm the CEO of City Financial Global, and I'm pleased to introduce you to the next interview in our series. This afternoon we are interviewing Will Pearce, who's the partner at Davis Polk, also the chair of our upcoming event on the future of UK capital markets regulation, which is being held in central London on the 25th of September. Will, welcome.
Nice to see you again, Maurice. Thank you for having me.
Our pleasure. Let's turn to the questions. Brexit has often been blamed for the decline in London as a financial centre. However, Andrew Griffiths, the City Minister, recently pointed out that many of the reforms being introduced would not have been possible without Brexit. How do you think Brexit has influenced the current situation? Or for good or bad, and what other factors do you think are at play here?
So thinking about it, I think there are probably two bits to that question, Maurice. I think the first point in relation to Brexit, you know, at the end of the day, we've spent however many years putting in place a uniform, common, pan-European capital market structure. I think as somebody that's been doing this for almost 30 years, we were very lucky that the European system, was certainly inspired in large part by the rules and the regulations that we did have in the UK. But it is true that with directly applicable common rules across Europe, the FCA as our regulator had got limited flexibility to sort of deviate from those common rules. Yes. And to adapt to changes in the market, to adapt to changes in the way investors view the world. You know, you can't have a common European prospectus and then have one member state go off and make changes and offer, offer relaxations for particular deals or particular investors. So Brexit does give us an opportunity, does give the FCA, the government, an opportunity to look again, particularly at the content of prospectuses. Yes. That's certainly true. You know, when is a prospectus required? How detailed should it be? Can we offer more derogations, more flexibility for particular types of deal? For example, to encourage growth companies, to encourage retail investment. So I certainly agree with that. But I don't think Brexit is the only thing at play here. So I think if you look back at, I don't know whether it's 5 years, whether it's the last 10 years, the two other things for me that have been shaping where we currently stand are probably a shift from public capital and a focus on public capital markets to private capital. Yeah. We've seen that with the strength, the continuing strength, the emergence and then the development of the strength of large multinational private equity and financial sponsor investors. So pension funds giving their money to a private investor to invest, rather than pension funds choosing to invest that money through the public markets. And I think that's had an impact everywhere, not just in the UK. And then probably the other factor, the other development over the last, call it 5-10 years, is suddenly globalization. So companies, rather than a company choosing to pursue a listing on its local exchange, companies have looked and said, well, where is the right capital market for me? Whether that's London, whether that's Amsterdam, whether that's New York. And unfortunately for us in the UK, particularly if you look at some of the tech companies, some of the life science companies and growth companies, the attraction has been the US, has been New York. Largely, I think, because there's a perception, probably a reality, that there's a broader investor base there, greater research coverage, that people understand those kind of growth companies, and investors are more willing to sort of put their money into those stocks on the US exchanges rather than London.
Yeah, if that's the case, what do you think the USP is for the London markets? If you were to single out one or maybe two issues, what's the USP that should be attracting companies to London?
So look, I think historically the UK has been viewed, we certainly were at the forefront, have been at the forefront and I would argue remain at the forefront of corporate governance. So if you look at all of the developments that we've had in London, be it composition of the board, now there's a huge focus on sustainability disclosure, ESG disclosure more broadly. So adding the E and the S to the G. The UK was suddenly first out of the gates with governance disclosure and taking governance seriously, largely driven, admittedly at the time, by the views of the UK pension funds, the UK long funds that were investing in UK stocks. But that for me remains a USP, and I think we have clients that think about where should they incorporate their holding company. A UK holding company, both in terms of certainty of corporate law, certainty of English law, and attractiveness from a tax perspective of putting a UK holding company on top, again is a real selling point for London.
But you talk about corporate governance and our leadership there, but of course in some of these proposals, there's going to be a relaxing of the requirements of the listing regime, and the gold standard, as people used to describe it, is going to be somewhat undermined. And do you think that will affect the attractions of London as having a gold standard of regulation, or is this a race to the bottom? How do you see it?
So presumably there you're talking specifically about sort of the requirement to get shareholder approval for large transactions and transactions with related parties. Well, yes. Look, I think my colleagues in the States would hardly describe the US exchanges as the bottom or the race to the bottom. I think anecdotally, certainly I've done a lot more transatlantic or been involved in a lot more transatlantic transactions over the course of the last 10 years. And I would say that UK public companies do find themselves particularly in a competitive M&A process where speed and certainty of execution or can be incredibly important. I think UK public companies have found themselves at a disadvantage participating in those processes because of the requirement to put together a shareholder circular, get the shareholder circular cleared by the regulator, look at pro forma financial information, which can take a little bit of time. For some sellers, that just adds to the burden of the sales process, and they choose to go with the quick execution and the cash over the UK listed company. So I don't, I get balancing the needs of investors, but I think I think it's pretty fair for people to argue that at one level those class transaction rules have made UK public companies uncompetitive in the context of competitive sales processes. I think for the FCA, they probably, and as part of the ongoing review process, the most important thing is to take a consistent approach. So there are arguably, other provisions of the listing rules that the regulators may take a look at if we're moving more to the US model of continuous disclosure and having investors rely on continuous disclosure regime rather than giving investors a sort of blocking vote or a veto over the action of management. Maybe a consequence of that is that you'll see UK shareholders hold management of public companies to account for. Some people would argue that's a good thing.
And I suppose one of the other parts which we haven't really quite touched on is in terms of a comparison between the UK and the US. The US has far more of a retail investment culture, investment in equities and so on, driven by other factors as well. But how do we go about having something of the same here in the UK, driving retail investment into the UK equity market? What are your thoughts on that?
Look, I think that's a complicated one to which there is no simple answer. I'm not old enough to have been involved in the government privatizations of the 1980s. I certainly was involved in the dot-com floats in the early 2000s, where obviously retail investors played a really important part, and the stock was attractive to retail investors. And then I was involved in, big retail offers like the demutualisation and London listing of Standard Life back in the day. So it certainly, the rules have not prevented. I think if we were looking objectively at it, the rules have not prevented retail investment. It's just that investment in public equity for individuals has sort of gone out of fashion and become a little bit too difficult. If you look back to, you could say that one of the really good things about the COVID capital raisings, so as you'll be aware, there were a lot of UK public companies that raised money off the back of a press release using platforms like Primary Bid. You could argue that those COVID capital raisings demonstrated that there is retail appetite out there, and that maybe with a little bit more flexibility in the rules to allow lesser disclosure, or to allow disclosure that's perhaps in plainer English and more focused at investors than a prospectus regulation style summary from which you cannot deviate or use plain English. So the ability to produce documents that are specifically targeted at retail investors, that takes us back to the top of the questions. And one of the benefits of Brexit gives the FCA the flexibility to allow companies to do that.
Yeah, and let's hope that that flexibility is embraced and we manage to drive things forward. We've run out of time. Thank you very much for sharing your thoughts with us. That was very, very interesting. And for our viewers, I very much hope that you'll be able to join us at the summit itself, the Future of UK Capital Markets Regulation Summit in central London on the 25th of September. So that's it. Thanks very much.